All right, guys, we're back with my maiden voyage into the interview world. This was my first time doing a solo interview, and I'm not going to lie, I was a little bit nervous. But we interviewed Matt Porter. We take a deep dive into EBITDA, Addbacks, practice evaluations. Super dense episode. I want you guys to get a pen and paper and go ahead and listen to the episode. All right, guys, we're back with another week here of the Pursuit of Ownership. This is Aaron here, and I have Matt Porter of Menlo Transitions, and he's here today to speak with us about evaluating practice. How you doing, Matt?
I'm doing great. Thanks for having me on, Aaron.
Yeah, we're super excited for you to be on. So Matt was originally on season 2 about 2 times, speaking with Richard about kind of his way he evaluates practices, and we thought that it's been about 3 years, so we figured he has a more refined way of actually evaluating practices, and so we wanted to bring him on to talk to him about that new method.
Appreciate that.
Yeah. Go ahead. I'm sorry, Matt.
No, you're great.
So the first thing that I want to talk to you about, Matt, is what is the best method for somebody to reach out to you initially and to put their best foot forward so that you keep the buyer at the top of your mind when you're actually seeing practice come on the market?
That's a great question. In my market, I work specifically in the state of Arizona, but in my market, as well as probably any other market in the country, there's definitely an imbalance between prospective buyers and prospective sellers. There's a lot more buyers out there. So for me, one of the jobs that I have is to kind of filter through or maybe sift and prioritize who I think are ready, willing, and able buyers versus those who are just kicking tires or maybe a little bit too early and too preliminarily reaching out to me in their search. So for me, I like to hear from somebody once they've been out of dental school, maybe 6 months to a year. If I'm hearing from somebody that's a D3 or D4, it's great that they're getting their ducks in a row, but there's nothing I can really do for them to prepare them years in advance for that practice purchase. Broker's main objective is to find a buyer now for a transition or an outright purchase of a practice. So a broker generally is going to want to find someone that's pretty much ready to go and queued up. And what that looks like is a dentist that's been out of school for a minimum of 6 to 12 months, has some cash saved up, has anywhere from 5 to 7% of whatever the purchase price is of their objective practice. If you're wanting to buy $1 million practice, most lenders are going to want you to see $50,000 to $70,000 in savings, checking, investment accounts that are non-retirement in nature. And
before you go on there, Matt, so I have a quick question. So $50,000 to $70,000 liquidity, is it better for someone to more aggressively pay down some loans, or should they just, hey, don't even worry about loans right now, let's just make our payments and let's save up that little nest egg?
That's a great question, because the answer is kind of counterintuitive. And all the Dave Ramsey disciples out there will, cast stones at me. But the reality is it's much better for you to save money, put cash in your checking account, put it in an investment, mutual funds, whatever you want to do, but keep it cash on hand instead of paying down your student loans. My advice, and this is conservative advice, believe it or not, is to make the minimum payments on your student loans. Lenders don't care nearly as much about your student loan balance as they do about the cash that you have in your checking account. Okay. And the reason for that is when you buy a practice, there's going to be some initial working capital expenses, and there's always kind of a growth curve as you're getting ready and going, especially if it's an insurance or PPO type practice where collections are going to lag production a little bit because your money doesn't come in for the first couple of months as you're producing. But those bills come due: rent, utilities, salaries, supplies, labs. All those start accruing pretty quickly. So the bank wants to know that you have a little bit of money in the bank to weather those first couple months and to provide extra cushion and stability during those first couple months. So even though they're going to loan you 100% of the purchase price, and even though they'll probably give you some additional working capital, they want to know that you have another buffer set aside of cash, anywhere from 5 to 7% of the value of the purchase price. So yeah, student loan balances, banks are not very concerned about. So you're believe it or not, shooting yourself in the foot if you're aggressively paying down student loans and trying to minimize your debt.
Okay, that makes total sense. And so somebody who's been working 6 months to a year, is there a production value that you would like to see, or is that just totally dependent on the size of practice that they are actually looking to purchase?
Size of practice. You just want to make sure that you as a buyer can fill the shoes of the seller. Same types of procedures. Banks don't get that granular. They're not going to look and see, oh, you place implants, the seller places implants. Okay. But they do want to see, hey, if he's producing 70,000 a year, you need to produce, 60 or 70,000 a month, you need to be producing something close to that level. So banks will look at your liquidity, how much money you have, your production. They'll want to see that you've been out of school usually about a year, most dental lenders. And then they'll want to see a decent credit score, high sixes, low sevens, something of that nature. They don't have extremely high standards when it comes to a credit score. They just want to know that you don't have a recent bankruptcy or any accounts in default.
Okay, makes total sense.
So to answer your question, I'd love it if somebody calls me up and says, hey, Matt, I've been out of school for about a year. And they check all those boxes and say, I'm ready to buy, and I kind of know the criteria that I want to be in these cities with these operatories with this production level. That's ideal. But I don't expect everyone to be that far in the game. And it's okay to reach out to a good broker a little bit in advance of that and say, hey, I'm actively looking. Brokers in each local market will know who's the strongest and best lender in that market. The best lenders in Arizona may not be the best lenders in New York or California, because each bank kind of has a regional footprint, and even the national lenders have a different appetite or credit box that they want to see deals fit in. So it's good to talk to the broker and ask them, hey, I've done these things that I've kind of heard are generally what the banks want to see. Send me to one or two banks in your local market. Get pre-qualified as a prospective buyer or borrower from that bank. And then kind of have a general sense of geographic vicinity, maybe types of procedures, types of insurances, and number of operatories. And that's what you can do to help a broker know that you're a legitimate, interested buyer that they should keep top of mind.
That makes total sense. And so just to ruffle your feathers a bit, because I know we do have a bunch of D3, D4s that listen to the show. Is there any way that they could get your attention? Could they say, hey, I've already spoke with a banker. He's willing to lend me X amount of dollars. Won't necessarily be pre-approved because we don't have production history. But is there really any way to pique your interest as, let's say, a D4 student coming in January, let's say right now looking to buy once they graduate in May?
So Aaron, I'll tell you what the typical broker would say. That answer pretty consistently across the board is going to be no. Because if that broker has a good practice with good production, good cash flow, good hygiene, all the hallmarks of a good practice for sale, they're going to have a couple legitimate, experienced, licensed dentists in the market that they're looking to buy and are pre-qualified. And so there wouldn't, and a D3 or D4 looking at that same practice, even if they have good fundamentals or good commitment from the banks, any broker is going to look at that and say, hey, there's a higher likelihood that the existing licensed, experienced dentist in my market is going to move forward and close on this practice more likely than a D3 or D4 looking at that same practice.
Well, all of us D4s collectively have shed a tear from hearing that answer.
And don't take that as my gospel, but
no, it's okay.
I meet with brokers across the country, and we have our, right. We sit down and we collaborate, and that's pretty consistent across the board. The broker is looking for who the best immediate fit is for that practice, because their client, the seller, wants to find a successor, and they want to find the most sure thing the quickest way possible.
And I don't blame them one single bit for that. Okay, let's make a small little sidestep here. Let's go into, we have a practice and we'd like to evaluate it. And again, since you've been on season 2, that's been about 3 years ago, and you spoke about in that episode 3 years ago that you evaluated practices differently then than you did the prior 3 years. So now we're 3 years ahead of that point. And I want to know what has changed, how have you refined your systems? And again, I'd like to go step by step through that process with you.
You bet. So My feeling is my craft is similar to any professional. You need to be continually learning, growing, talking with colleagues, taking continuing education, and hopefully pushing forward with new skills and certifications. So just like any good dentist does that in their career, I've tried to do that in my business as well. And certainly your point, 5 years ago, I had a specific valuation approach. 3 years ago, I'd made some changes and adaptations to that. And the big change initially was focused on collections and profitability, fairly quantitative in approach. Then about 3 years ago, I felt the need to apply qualitative factors to the valuation. And what that looks like is giving a numeric score and weighting to the type of insurance that's accepted, how strong the hygiene is, types of procedures that are done, the equipment, the tenure of the staff, visibility, local supply and demand. All those qualitative facets I tried to add a numeric value to and score them so that two practices with identical collections and profit may still be very different in cosmetic makeup and therefore worth different values. So in the last 3 years, I've continued in the iterative process of refining the way I look at valuations, and it's very subjective. Everybody approaches valuations differently, just like every dentist can approach a comprehensive treatment plan a little bit differently. So I actually went back because I felt like I wanted more concrete approach. I went back a couple of years ago and became board certified as a certified business appraiser. I went through the NACVA's path to become a CVA, a certified valuation analyst. Sometimes I'd be working on a divorce valuation where I'd be called as an expert witness. And although I could speak authoritatively to local market values based on recent transactions, I really wanted to go through and have the credentials behind it. And going through that process actually changed my perspective on valuations a little bit. So if you don't mind, I'll take you through what the main differences are. I've taken a little step back from trying to measure every qualitative aspect, and based on the virtue of our firm having done a couple hundred transitions in Arizona, we've built a significant internal database of comparable sales. And that's not something that's readily available. Unfortunately, there are a few small public databases of recently completed dental transactions, but not enough to really glean a statistically significant market share. But we've done that internally through our 200 transactions. So I believe at the end of the day, the true arbiter of value is supply and demand. So I care about recent comparable sales a lot, and I put a lot of weight on that. It still starts with the same process. Look at the collections, look at the profitability, make adjustments to the financials to figure out what the true collections are of that practice, what the profitability is. I still look at the last 3 years. I do a weighted average of the last 3 years, unless there's extenuating circumstances. I look at a weighted average of the last 3 years, meaning 2019, I weight at a 3, 2018, I weighted at a 2, 2017, I weight at a 1, because I believe last year's more indicative of the current value and performance of the practice than 3 years ago. So I still do all of that financial analysis to give me my benchmarks. So I have a weighted average collection number and a weighted average owner discretionary income number. And then I apply those to averages of maybe 10 or 12 very similar practice sales. So for me in Arizona, if I have a practice doing $1 million with 400,000 owner profit in Scottsdale, I pull 10 or 12 comps from my database that are Scottsdale sales within the last 5 years that are between 900 to 1.2, profit from 300 to 500, single GP doc that's mostly PPO. So I kind of find those criteria. I apply the comparable sales. And then there's one big change that I've added to every valuation. After all the calculations and computations, I come to a value for that practice. And then I make what's called, the business term is a capital expenditure adjustment.
Can you explain what that is for everybody?
Yeah, so accountants will call it CapEx, but capital expenditure is a significant one-time expense for physical assets. Layman's terms for a dental practice, I look at that practice and I say, okay, if this is a film practice and they don't have digital sensors and they don't have computers yet, it's going to cost me $75,000 to convert this practice to being digital. So there's no computation in anybody's valuation, mine or other, up to that point that accounts for the $75,000 you're going to have to spend in the first couple months to bring it up to standard of care with digital. So I do a capital expense adjustment at the very end. It's basically like moving the number up or down based on equipment. That's the single biggest aspect of every valuation that seems to be missing as I look at the market. Is an adjustment of equipment.
So is it only equipment? Is that the only capital expenditure that you're adding or taking away?
Yep, equipment or technology. Yep.
Okay.
Yeah.
Okay. And then where are you basing those numbers? So it's like CBCTs if they have a CEREC in-house milling unit or things like that. And then are you just taking like an average number for those things, or is that more, I don't want to say proprietary information, but that's more like where you are using your comps from previous sales to actually make those adjustments? Is that correct?
Yeah. So what I do is I make the assumption in my market that the average value of equipment per operatory in a resale practice is about $15,000 per operatory. So the used value of the chair, the delivery system, the X-ray head, the sensors, the computers, it's about $15,000 on the average practice. That's and don't get too caught up in what that value is. Is it the replacement cost if you had to re-equip that operatory? Is it the value of the equipment if you stripped it out and sold it part by part? It's just the in-place value of that equipment is about $15,000 per operatory. So I go through the practice and I'll usually have an equipment specialist, somebody from Henry Schein or Patterson or Ben Gore Burkhardt, come into the practice and tell me what the equipment is worth. They'll go through and look at the make, model, and age of the CBCT, the make, model, and age of the CAD CAM, the chairs, if there's a laser, just big ticket stuff, not as granular as hand pieces and instruments. But they'll go through and say, hey, Matt, the value of this equipment based on these big line items is about $90,000. Well, if it's a 4-op practice, 4 times $15,000 is going to be $60,000. So the average expected value of equipment in an office of that size is about $60,000. The equipment guy told me that the value of this equipment is $90,000. So I add a $30,000 premium to my calculated values. Because the reality is, a couple of years ago, everyone was focused on collections and they were missing the point that profit matters more than collections. I feel like the industry's finally, minus the lenders are a little bit lagging, but most educated, sophisticated buyers and consultants are now starting to understand that profit matters more than collections. But what they're still missing is once you get in that office on day one, how much are you going to have to spend in the first 6 to 12 months in technology and equipment upgrades to modernize the office? Or is this a turnkey office where somebody's been reinvesting in technology and equipment and you don't have to spend anything in the next 3 years? Your technology is top of the line. That makes a huge difference and is really an indicator of value that's left off of most calculations and equations.
Yeah, so this is very interesting. So in my head, let me say this out to you. So it looks like you've broken it into 3 ways. So the initial way that a lot of people still value practices is based on profit, right? So we're going to have some sort of multiplier to actually get to that price. Then you have almost, I want to say, like a real estate piece where it's kind of like comparing comps like real estate does. And so that's the second part of the equation. And then the third part is this equipment. And I can't remember the exact term you used. What was it?
Capital expenditure
For the third piece. And that comes to our overall value of what you think the practice should be.
Right. And I took that piece from the CVA certification that I went through because it's certifying for me to be able to appraise a business of any size, of any type. I think the case study that I had to do for the boards was a printing and lithograph company. And they have capital expenditure of new printers. And those laser printers are hundreds of thousands of dollars and screen printers. And I thought, well, gosh, this definitely applies to dentistry because there's technology and equipment and computers and servers that continually needed to be upgraded, and those aren't reflected in profit and collections. And one thing that I've seen really interesting to make it applicable to real time, I think it's by the end of this year. I could be wrong on this, but if it's not January 1st, it's by January 31st of 2020. One of the requirements for the new HIPAA compliance is that all office computers run on Windows 10.
I bet Microsoft is so happy.
They love it. And IT guys are running around the streets, high-fiving each other because every practice in the entire state has had to call up their IT guy or gal to come out and most likely upgrade the hardware to run Windows 10 and then buy a new license for Windows 10 for every single computer in the office.
Oh man, somebody is just high-fiving in the background, aren't they?
Yeah, the computer industry has their lobbyists in Washington, D.C. They're lobbying for HIPAA compliance to include, the current license of Windows, so everybody has to upgrade. But that's thrown a huge wrench in practice ownership because I have practices that are selling on December 31st that I just had to negotiate with, and the seller's running on Windows 7, and they're like, man, I'm not going to spend $20,000 for new computers, new hardware, and new license for the entire office. The buyer's like, well, I don't want to have to drop $20,000 on day one just to bring it up to compliance. But those are the type of things that practice owners know cost money, and buyers often overlook in terms of hidden expenses right after you buy a practice.
Yeah, that is terribly interesting, and I've never even, this is the first time I've ever heard that actually being added to the equation. Very, very interesting. So I want to do one thing. Let's go back to our initial piece of evaluating the practice price on profit. Do you use any specific multipliers to get the range of price? And then how are you distinguishing the things in between? If this is in the low range or if this is the high range, how are you moving that needle between those two?
Okay, that's a good question. And to take a quick step back to make sure we're talking apples to apples, I find that the most commonly misunderstood term in all of practice values is EBITDA. It's pronounced differently, it's spelled differently. Nobody can seem to get on the same page with what it is or how it's calculated, right?
Right. So tell us how you define it.
It's so misunderstood and misused. I don't even talk EBITDA when it's a sole practitioner. So let's say you own a practice, you're the sole practitioner. I value profit as what's called owner discretionary income. Could also be called seller discretionary income, but it's basically the total economic benefit that you're getting as an owner. So I make my adjustments. I look at your tax return and I add back the usual suspects: automobile, travel, meals, CE, entertainment, spouse salaries. Then I add back what you paid yourself on a W-2, what you paid your 401k contribution, and what the corporate profit was. All of that added together is your economic benefit for the year that you derived as being the business owner before taxes and before loan payments, before amortization. That's owner discretionary income.
Okay. But before we move past this, there's one important thing that I want to talk about there: Addbacks. So I have seen a couple reports back from brokers, and it seems there's some may be a little bit more liberal than others on what they add back.
I hate that.
Is there somewhere that somebody can look at this? Go ahead.
Yeah, I hate how subjective that is, and probably a lot of good quality dentists feel the same way when they see a treatment plan from another competitor or another colleague down the street, and it's a completely wildly over the top aggressive treatment plan of things that aren't needed. And you as a dentist hurt for your profession. That's how I feel when I see other brokers' assessment. I looked at one recently where the practice was spending $75,000 a year in advertising, and the broker adjusted it down to $10,000. And the dentist was spending $40,000 a year in consulting, and the broker added that back and said, you don't really need to spend $70,000 in advertising. You can only spend 10. You don't need to spend this money on consulting. You can just do it yourself. I would never agree with the legitimacy of those addbacks because a lot of those categories are inextricably tied to the performance of the practice. If I'm taking out the advertising budget, what do you think is going to happen to production and collections? Right, exactly. And it's great for me to sit here as a broker and say, well, listen, this guy isn't very smart in the way he runs his practice, so he's kind of throwing advertising money away. It's not effective advertising. You really only need to spend $10,000 a year in effective advertising. That's highly subjective and theoretical and speculative in nature. And I'm never going to base my analysis on those type of things. So my gospel, I don't touch advertising. I don't touch marketing. I don't touch consulting fees. I see a lot of brokers adjust headcount and say, hey, there's 3 front office staff, but you really only need 2. Take this person out. Never. Because that's going to have a domino effect in any of those categories that's going to affect other aspects of the business. You can't just in a vacuum make certain addbacks. So for me, I only go with the traditional automobile, travel, meals, CE, things of that nature. I'll adjust accounting to a reasonable number, but that's about it. I add back personal insurances, if your family's health insurance, or insurances are specific to an owner, their disability and their life insurance.
Okay,
but
that makes
that
makes total. I still have a couple more questions on that specific thing.
Go.
And this is 2 line items that I've had people ask me about, and I don't really know the right answer for. So I want you to tell us. So I want you to explain depreciation and interest expense, and if those are added back into it, or how does that play with the profit of the practice?
Always add those back. Yeah.
Always. Okay.
Always
Can you
add those
explain
back.
can you explain what they are and how, why they're there and how that affects your taxes and those type of things like that? Because I don't really have a great grasp on that.
The reason why is because accountants and CPAs are doing the same things that dentists are doing. I was in a meeting with a couple of dentists on Friday afternoon, and they were talking about torquing something to Newton meters or something like that. And I have no clue what that means. I don't even know if they were making that term up on the spot, but it reminds me that I'm a layperson. And so accountants and CPAs are guilty of the same thing, where they come up with this technical jargon that kind of makes them feel like they're necessary and important. They speak in the language to help, show everybody how intelligent they are and that their business is so special and uniquely adapted. So they've come up with words like depreciation and amortization. Don't get confused between the two. They're basically synonymous. Depreciation and amortization are the same thing for as far as any dentist needs to know. That is a non-cash expense of the business. That's one of the ways in which you can benefit from being a business owner. Once you own a practice, you bought it, you can start writing that depreciation off every year. So if I buy a practice for $1 million and I can depreciate it over 10 years, that means every year for 10 years, I can tell the IRS that practice is losing $100,000 of value each year for 10 years. And then I get to that $1 million number. So it's a taxable expense, but it's not a cash expense. You're not writing a check. You're not actually spending money on depreciation. It's just the IRS's way of saying that over 10 years, your practice is decreasing in value, just like a car depreciates. You buy it, and every year it's worth less than the last year because it's got more mileage and wear and tear, and then the resale value goes down. That's the theory of your dental practice, and it's called depreciation.
So if I had a practice, let's say that $1 million practice, we're netting $500 in income, I can depreciate $100,000 of that, so I would basically only being taxed on $400,000.
That's correct. That's correct.
Okay.
But your money in your pocket that year was how much?
$500,000.
Exactly. So it's a non-cash expense, and it's one of the great ways that Uncle Sam's basically helping pay for your practice. Depreciation ends up being about 30-35%. The depreciation taxable benefit ends up being about 30-35% of what you paid on the practice. So if you're paying for a $1 million practice, over the next 7 to 15 years, the IRS is basically making 30-35% of those payments for you by way of giving you a tax break. So next time you're ready to complain about Uncle Sam, remember that he's paying a big chunk of your payment every month. Or subsidizing.
Thanks, Uncle Sam. And then the other one is interest expense. So is that if I buy a large, CPCT and I am paying for it? Explain it to me. I can't even explain it.
So interest expense, there's either when you get a loan to buy the practice or you get a loan for a piece of equipment. Every month you make that payment, there's a portion of that payment that's principal and a portion of your payment that's interest.
Yes.
The interest portion is tax deductible. So if you bought that practice over the course of the first year, you'll get an expense statement from your lender that says, hey, you paid us $75,000 in interest this year. That's a tax expense. So you can write that off on your taxes also. Now, you actually paid maybe $95,000 in loan payments. But that other $20,000 was principal payments, which you're also benefiting from because it's reducing the amount that you owe on the practice and therefore increasing your equity or your ownership every year. So your ownership grows by $20,000 every year, and then you get $75,000 of that as a tax write-off each year. So you can't write off the entire payments as a business expense. You can write off the interest portion, and that's kind of how interest works. You cannot write off. But listen, we're getting outside of my scope of expertise, but just know that don't get confused that you can't write off the entire purchase price, and you can't write off student loan interest as a business expense.
Okay, no, that makes absolute total sense. Okay, so let's say this: we have our owner discretionary income. That's the correct word to use, correct?
Yep.
We've added that all back together, and let's say it's $500,000. Then how are you determining the high and low range from that owner discretionary income?
So I used to do that years and years ago as I kind of give a high and low range. But now that I have market comps, I use an exact value. So I'll take my 12 market comps, and then I take those 12 comps and I look at their owner discretionary income, and I look at the median, the mean, and the harmonic mean of all 12 of those owner discretionary incomes. That will give me a specific value, and it'll say, okay, similar comps, similar 12 practices, the mean, median, and harmonic mean of those three is 1.75 times owner discretionary income. So then I apply that 1.75 times my subject practice. That gives me my specific value. And then I apply my CapEx or my equipment and technology adjustment.
We are way more sophisticated these days. That's for
we
sure.
Are. Well, we need to be. And here's why I feel that way. Because practices are developing very rapidly, and every year there's a broader gap in technology and equipment than there ever used to be with practices. Mm-hmm. 10 years ago, pretty much most guys were doing the same procedures, and most guys had the same technology, and most guys had the same profile of insurance. It's like all the practices were more homogeneous 20 years ago and 10 years ago, so you could use more generic rules of thumb. But now that profitability is vastly different from one practice to the next, technology is vastly different from one practice to the next, the type of advertising and marketing, the type of procedures being done, there has to be more sophisticated analytic valuation to speak to those variances.
That makes total sense and is very, very interesting. I want to get your take on this too. Let's say we go off market. I know this is like against your grain since you are quote unquote an on market guy.
Yeah, but before we answer that, I want to answer one more thing. So we talked about EBITDA, and then I never actually got to say what EBITDA was. So follow me back. I don't use EBITDA for a single doc practice. I use owner discretionary income and a multiple of that. However, if it's a multi-provider office, you have 2 docs, a doc and associate, multiple locations, then I use EBITDA. And here's the biggest misconception on EBITDA. EBITDA is an acronym, once again, that CPAs invented to ensure job security. It stands for earnings before taxes, depreciation, and amortization. And interest, taxes, depreciation, and amortization. And the one thing that's always missed in that is adding a normalized provider salary. What that means is you need to add back all the economic benefit that you and the associate get paid. And then you need to look at the production of the office that's operative in nature, that's done by the dentist. Not pro fees, not x-rays, not SRPs, not period maintenance, not retail sales, everything that's operative in nature. and whatever the market comp is. In our market, roughly speaking, is 30% of collections. Take that 30% of operative collections, add that as a provider expense, and then the number that's left over is the true business profit. But so often we confuse EBITDA with owner discretionary income because we forget that you're wearing two hats. You're a provider and you're an owner. So you need to add in a provider salary. So I have some docs that tell me, oh, my EBITDA is, I have one practice that's doing $1 million and I'm taking home $400,000. And I say, oh, my EBITDA is $400,000. Well, no, my EBITDA, let's say 20% hygiene. So 80% of it's me. 800,000 of my collections times 30% is 240,000 is what I should be paying myself as a provider. So 400,000 was the business, was the preliminary profit, minus 240 is what I'm worth as a salaried provider. So 160 is my EBITDA. And guys get their hearts broken because they've heard these multiples. Oh my gosh, groups are paying 4, 5, 6 times EBITDA. And my EBITDA is 400,000. So 4 times 400,000 is my practice is worth 1.6 and I'm only collecting $1 million. That's amazing. And the reality is that 4 multiple is, 4 times 160, that's 640,000. That's 64% of collections. So it's so imperative that we understand when's the right time to use owner discretionary, when's the right time to use EBITDA, and then what is EBITDA. Okay, I've said my piece. Now go ask me about upstream listings.
And just jump back to that. Yeah, I've always understood EBITDA as, just the business profit, not including the doctor's salary. So I always kind of separated those two. But you're saying single doc, just lump them together. Yes. And unless you're doing multi-provider, but you are still adding in, if an associate was working there, that salary would still be added on to the EBITDA amount, correct? And that's
right.
When you'd have it all lumped together. Okay.
And here's why I don't use EBITDA when it's a single doc.
Because you're taking everything home. It doesn't matter.
That's right. I'm not just buying a passive business. I'm buying a job. And if that practice provides a ton of production for me, or I can produce a lot, make a lot of money, that's part of what my assessment should be is, man, I'm buying a high-paying job and a business at the same time.
Makes absolute total sense to me. Okay, let's jump over to off-market practices. Let's just say this. You're met a couple dentists. They send you a couple P&Ls, a couple production reports. Is there any way that you can look at that information pretty quickly and be like, this practice passed the test of, hey, this is a good practice, or based on these couple red flags that this is not a practice that I would actually want to go down? Do you understand what I'm saying?
Yeah. If you kind of understand the methodology of making adjustments to a profit and loss statement, it's pretty easy to look at a P&L and go through, the line items that you need to adjust: automobile, travel, meals, CE, entertainment, things of that nature. But then you always need to have a follow-up question, because usually there'll just be a single line item for salaries. So you have to say, hey, doc, what was your W-2 last year? And out of the employee benefits, insurance, and 401k, how much of that was yours? So that's question number 2. And then question number 3 is, do you have any spouses or children that are non-working employees of the business? Mm-hmm. And so with those 3 answers, man, you can pretty quickly determine what the owner discretionary income is, shorthand. And then I'd always want to see the office too, because of that thing that I just talked about with capital expenditure, or what level the equipment and technology is at.
Yeah, because you guys spend $100,000 on top of that, then all of a sudden we're getting pretty expensive, rather than we already got ready to rock and roll. Makes total sense. Yep. Do you have any ranges that you like to look at? Let's say staff costs. Is there ranges you like to look at where, like, this is a good range, this is a no way, no chance, and you know what, I'm going to go with this one? Can you share those ranges you like to look for? Let's say staff, facility, supplies, the big ones that's going to be the largest.
Yeah, like I said, every year there seems to be more variability in what those ranges are, because some practice owners are becoming very sophisticated and others are just kind of keeping the old standard. And so there's becoming a bigger gap in what the norms are. Generally speaking, ideally, general dentist, single practice, I'd love to see 22 to 25% for non-doctor staff salaries.
Okay. And that's tell me what's included in that. That's not just salaries. Is there more included on top of that also?
That's just salaries. That doesn't include.
What about like benefits? Okay, so that is not included in it.
Yeah, yep.
Okay.
Just W-2s, 22 to 25%. I don't sweat anything south of 30% if all the other fundamentals are good about the practice. If it's 27 or 28%, I'm still okay with that. That's outside of my ideal range. But tenured, experienced staff is a double-edged sword. If you find a practice where the team's been in place for a long time and they've been highly trained, they're going to be highly compensated because every year or two, the doc feels the need to give them a slight cost of living increase, and a 2% annual increase over 15 years of tenure adds up pretty quick where everyone's making above market rates a little bit. In our market, hygienists are maybe $37 to $41 an hour. Sometimes on some practices, the hygienist is making $44, $45 an hour just because they've been there 15 years. And the goodwill that's intrinsically tied to that hygienist necessitates that you keep them at whatever it is, 44, 45 an hour. So if there's a good reason for a couple of the salaries being really high, I'm okay with that. 22 to 25 ideally, up to 30 is okay. Anything over 30 is really stressing me out.
Okay, that makes total sense. And again, I've always understood it that you're adding back in benefits, but it's much more simple if we're only worrying about those salaries. That really brings it down to a much more granular level, and it's easier to actually look at those things.
The benefits are kind of hard to tease out too. I find that most practices aren't providing benefits anymore, or they're really small onesie-twosie benefits. Even practice owners who have been in practice for maybe less than 10 years haven't had the need to competitively offer tons of benefits and perks, so they don't. And dentists that have been in practice for 20, 30 years, during the economic downturn of 2008 to 2012, peeled back a lot of those benefits and discontinued health insurance, discontinued 401ks, or minimized those plans significantly and haven't reinstated them. So I don't find a lot of practices with heavy 401k and health insurance plans anyway. So it's kind of a negligible number. It's going to be 1%, 2%, 3% of revenue anyway for all the benefits.
Okay, makes sense. And then what about for facility expense? What's the range that you don't like to go over?
6 to 10%.
Okay. And then supplies is about the same range.
Supplies about 7%. I find some really, really good practices can get down to 3, 4, 5%. If they're buying in bulk, they're buying in formulary, they're buying from different sources, you can move that number a little bit, but ideally 6 to 7% is probably the normal range that I see. Mm-hmm. And same with lab costs, unless they're doing a lot of Invisalign or implants, then it might be higher. If they're doing cosmetic veneers, it might be higher. But conversely, if they have CAD/CAM, E4D, or CEREC, I'd expect it to be like 3.5%.
Okay, that makes sense. I want to switch a little bit of gears here. Can you speak to any sticking points with practice sales? Some things like, hey, these are some things that I would watch out for. I'm sure over time you kind of have a couple issues that come up every single time that can kill deals. Can you speak to that just a little bit?
Sure. The number one deal killer in any transition is the lease or the real estate. That so often becomes an afterthought. If the real estate is owned, as part of the letter of intent that you submit to that doctor saying, hey, I want to buy your practice at this price and this closing date, you better define what's happening with the real estate. I'm going to lease it at this rate for this number of years, or I'm going to buy it outright at this price, or whatever the terms are going to be, I want an option to purchase it within this number of years. If the real estate's owned, you need to have the lease or building purchase terms defined and negotiated concurrent with the practice.
And I never thought about that.
Always that ends up being a deal killer, because half the time, way overgeneralizing, but half the time, the real estate is a more valuable asset than the practice. Mm-hmm. And so you're going to wake up with an owner that says, no, I'm never selling you this building. This is my retirement plan. I want $8,000 a month in rent, and I want it for the next 10 years. And then going back to your question about what should the facility cost be, when I say facility cost 6 to 10%, I mean just rent, not utilities, computers, phones, all that kind of stuff, because
Okay.
that's separate. But if that $8,000 a month rent is significantly above the percentage of collections range, we've got a problem, and that's kind of a non-starter because you're married to that rent amount for the next 10 years. That's not something you can easily adjust or outrun. So always define the real estate and negotiate it concurrent and up front with the practice. And if it's a lease, as soon as your LOI is signed, you need to reach out to that landlord and say, hey, if there's no broker involved, you reach out. If there's a broker involved, make sure the broker is sophisticated, has a real estate license, and reaches out quickly to say, hey, we're selling the practice. We need a transition of the lease. We need a lease assignment and assumption clause. Here's the financials of the prospective buyer, and please provide us a lease transfer document. Most landlords are going to want to look at the financials of you as a buyer. They're going to see that you're creditworthy. Most young dentists are not, because you're just coming out of dental school. So you'll need to overcome that objection, because the landlord's going to look and say, well, Dr. Porter's been in practice for 30 years and he has a net worth of $5 million. And Dr. Smith's buying his practice and he has a negative net worth of $300,000. I'm not trading one tenant for the other. And so then you have to start negotiating with the landlord. And the landlord is always a disinterested third party. They don't have a motivator to ensuring that the practice sale closes. They don't care. They're getting rent from their tenant already. They've got a stable tenant. They get rent every month, whether it's new guy or old guy, they don't care. So you have to get out in front with landlords, because this is not an urgent thing for them and they're not really motivated.
And again, that's very interesting. And one of the interesting things you said is that some brokers are real estate agents, so they can actually help that part of the deal also. That's the first time I've ever actually heard that before.
Yeah, if I were using a broker, I'd hope and like them to be a licensed real estate agent as well. And in a lot of states,
you guys wear many hats.
Yeah. So I won't speak to our firm, but myself and every other broker has a real estate license, and we have a sister company that has about 15 licensed real estate brokers. So we do everything in-house. If you're a small mom and pop brokerage shop, either they need to be a licensed real estate broker, or they need to have an alliance and refer you to a licensed real estate broker in town that will help facilitate that. Because transferring a lease is a real estate transaction by definition and by nature. So it needs to be, for whatever state's Department of Real Estate, it needs to be handled and managed by a real estate professional. Each state's a little bit different. Some states require any brokers to have their real estate license. Some states just want to ensure that somebody with a real estate license is transacting it, but absolutely get somebody with a professional license in there to take care of that real estate component, whether it be drafting a lease, selling the building, or just transferring the lease from a third-party landlord.
Yeah. Okay. That's great advice. So before we wrap this up, I just want you to tell us maybe one more sticking point, and then I want you to tell us a little bit about Menlo Transition, your company, and how people can reach out to you.
Okay. Other sticking point that I see is asset allocation. And I'm giving you all my trade secrets because, like I said, I operate. I want everyone else to have the best possible transition anywhere else. And any other broker that picks up maybe some tricks of the trade, that just means that as a whole, our profession is improving in the way we can provide service to dentists. So I add asset allocation in my letter of intent template. Letter of intent is just a simple, usually 1 or 2 page document that you submit initially after your initial review and diligence to say, hey, here's my proposed purchase price, here's my closing date, here's my earnest money, here's my transition plan, and here's what I'll do for the real estate. Really simple. Just make sure both parties are on the same page before you start investing money in consultants and lender approvals and all that kind of stuff, and attorney fees. So in that document, I include a section of asset allocation. And asset allocation, most everyone probably listening to this podcast has been at least initially indoctrinated in asset allocation. It's the separation of the value within the purchase price of how much of it's equipment and how much of it is going to be goodwill. And there's other small subcategories, but generally speaking, those 2 categories, buyers and sellers, are diametrically opposed in terms of what their objectives are. Sellers want as much goodwill as possible for advantageous tax treatment. Buyers want as much to equipment as possible for advantageous tax treatment. So that's an area where if you don't discuss it up front, that can end up killing a deal because it has a material impact to both parties. And I find that usually doesn't get inserted until the asset purchase agreement, the legal contract down the road, and can end up killing deals. And it did create some significant rubs on a couple of my deals. So I said, hey, I'm not the smartest guy in the world, but if this has become an issue down the road 2 or 3 times, I'm going to move this hurdle forward in the process and clear it sooner before the deal gets too sticky and we bring it up at the last minute. So asset allocation, have that conversation up front. And that's not something that, especially if it's an off-market deal, a young dentist and an old dentist sitting down and trying to figure out their deal together, that's not something that's going to be top of mind to say, hey, let's talk about asset allocation. You're usually worrying about, I'm going to wrap up this treatment plan, and hey, are you going to hire my hygienist? Are you going to keep the same salaries? And what are we going to do with this? And how am I going to phase out with my transition plan? But in addition to figuring out the clinical aspect, asset allocation has to be figured out sooner the better.
Can you share what the normal split would be? I realize there's going to be some variant, but what's a reasonable range for the two?
Okay, I can't just give you a reasonable range. If you learn nothing else from me today, you learn that I'm overly analytical, and I want to know reasons why certain things are done. I don't just like rules of thumb because the rules of thumb are usually wrong.
Right.
So the rule of thumb across the board is usually 70 to 80% is goodwill, and the rest is equipment. But I'll tell you, Aaron, the way I do it, I figure out what the value of the practice is. Remember, we went through that whole process. Right. Remember, I had my equipment guy walk through and say, hey, the equipment was worth, in the scenario we gave, is worth $90,000, right? Mm-hmm. So if the practice is worth $600,000 and the equipment's $90,000, what's left is goodwill. So $510,000 of that is goodwill. I loved algebra class growing up because remember there was always, no, you're shaking your head no. There's always, it's an equation that was always solved for X, right?
Right.
So, and the answer is like 2X plus 3 equals 7. Well, the equals is the value of the practice is 600,000. And we know what the equipment is, that's 90,000. So the variable in the equation is goodwill. Well, purchase price minus equipment equals goodwill. Mm-hmm. That's how every broker should do it, and that's how every CPA and consultant should do it. But you'll find most just default to 70 to 80%, and that's okay too until they get more sophisticated.
One day we'll all get there, won't we?
I'm on a crusade, man.
I love it. All right, so tell us a little bit about Menlo Transitions, and it is Menlo Transitions, or is it Dental Transition? Now that I said it out loud.
It's Menlo Dental Transitions. I'm not much in trying to drum up business for ourselves. I'm more out here just trying to help increase the level standard of appraisals and valuations and transitions. What we do in the state of Arizona, we're the largest.
Is it only in Arizona? That was going to be another question. Is it only Arizona, or do you venture out into other markets?
I do occasionally. I'll do certified business appraisals across the country. So someone calls me up and wants to do a certified business appraisal, I'll do that. I brokered a few larger practice sales, multi-practice sales out of state, but generally speaking, I stick to Arizona. So anyone wanting a certified practice appraisal, specialty or general, we do that nationwide. And then within Arizona, we broker the largest and the most practice sales in the state. I've spoken at probably most study clubs in the state, spoken at some of the dental schools, and I spend more time than I'd like doing divorce valuations and testifying as an expert witness in divorces. That's terrible.
Yeah, that's a little gray, isn't it?
No, it's miserable.
All right, Matt. Well, hey, we appreciate you coming on the Pursuit of Ownership. And can you give us maybe your email or way people can contact you if they would like to?
Sure. Website's the best place to start. It's just www.menlotransitions.com.
Okay, Matt. Again, we appreciate it, and thanks for coming on.
Yep, you bet. Thanks, Aaron.
All right, bye.
All right, guys. I hope you guys liked that episode. I know I learned a whole bunch from that, but I want to hear from you, Clay and Tyler. What do you guys thought about it?
Dense. I'm glad you said something about pen and paper because I think that's entirely necessary. I think if you listen to something like that while you're riding along in the car, you're just wasting your time, because like there was a lot of numbers being thrown around, a lot of terms that some people, including myself at sometimes, may be unfamiliar with. So I'm really happy we're taking some time to break everything down. What about you, Clay?
I know we interviewed Matt in season 2, and I think that was a great episode. This was an even better one. I mean, he kind of hit a lot of really, really good points. One of my biggest takeaways was in the beginning when he talked about what banks kind of look for in a prospective buyer, and I think a big thing for pre-owners is that usually they're coming out of school, they have a lot of student loans, and they're thinking, okay, how in the world can I afford a practice if I have all these student loans? And I think what Matt kind of mentioned too is that banks would rather see that you have money in the bank than putting a lot down on your student loans. So I think that kind of flies in the face of a lot of what, a lot of dentists are coming out of school, their mindset. So I think that's important because you want to look the best you can for those banks. So that way that's not going to hold you up. Tyler, what else did you kind of glean from that?
I think that's a fantastic point, because it really goes totally contrary to what the general idea is. Like, I'm going to get out and I'm going to aggressively pay down debt. I'm going to get myself in the black. And then, then we can talk about ownership. And, so much of the share practices philosophy has been about, if you want to pay things back aggressively, the key is to earn more money. And in order to get yourself into that opportunity, there are certain somewhat counterintuitive strategies sometimes to get yourself into that. And I think that's a whole can of worms that we really need to explore in future episodes for sure. So another thing that I was really feeling as I was going along, and we kind of mentioned this in the first episode, but myself and Clay and Aaron, we spent a lot of time early on working with George and Richard, learning about how to evaluate practices. And we didn't exactly know what to expect when we were going in to learn that. We were thinking maybe we're just going to learn about how numbers work and like how to look at tax returns and stuff. All that happened ad nauseum. But one of the things that kind of came out was, some of the tendencies of, brokers and people who are evaluating practices and enumerating these purchase prices, some of their tendencies and some of their biases, and how those numbers actually come up and what they're really being drawn from. And you see certain trends. And I felt so validated at times with things that Matt Porter said. And it just felt really good to hear that. I think one thing, in particular was the adjustments. And if you didn't quite pick up what was being said there, basically what was being said is that when a practice is being evaluated, a lot of times they will send you a pro forma, as a buyer, as a prospective buyer, you will be sent a pro forma, and it will kind of give you all these figures, and it'll show you what the current numbers for the practice are and like how money is being spent on different things. And then there will be this whole separate column of adjustments where it uses like industry averages or just certain assumptions that are kind of thrown in there that sort of take all those expenses and just magically make them smaller. And what it ends up on the bottom line is it tells you that you're going to be making more money, and it assumes all these different factors are going to change like as soon as you come into the practice, and it makes things look so much better than they really necessarily are. And that was something that was said kind of in the middle of the interview. And I really just, I love that. And I wanted us to dig a little bit deeper if we could. But there's a lot of little wrinkles that are super important. Go ahead, Clay.
No, I think Matt's example is kind of telling of what goes on. I think his example was, a broker looks at the practice and says, okay, they have 3 front office team members. Well, you only need 2, so we're going to adjust their salary. Yeah. When in reality, they might be integral into the success of the practice, Absolutely. And which is why you're buying it. So the Addbacks and the adjustments are something that I think people really need to pay attention to, especially if you're looking at a lot of different practices, and really, so you get the true actual reality of what's going on instead of what they want you to kind of think.
And the thing. Sorry. The only thing I want to say about that, and you're absolutely right, is like the point being made here is not to be super suspicious of brokers. We all have our own biases. We're all going to do our jobs to a degree of self-interest, but it's important for us to understand what those biases are and for us to be able to some effect evaluate practices to ourselves and just understand where these numbers are coming from, why certain adjustments are being made, why things are being moved around, who's motivated by what. This is important as a buyer, and it gives you a lot more power. But, I absolutely love that Matt Porter was able to, bring that up and make the analogy to, something that dentists do. It's a universal thing, really. And it's just important. And I just want to say that, it's not to make an enemy of brokers by any means. It's just, we need to be more.
Right. We're not anti-broker. We just want to make sure everyone's aware of what's going on. Sure. So, and Aaron, one of the things that Matt was kind of talking about since his last interview, and how he's kind of changed his evaluation method. And one of the big things that he's kind of implemented in there was the capital expenditure. Can you kind of go into a little bit more detail and kind of review what he kind of said in that interview there?
Yeah, so that's the third part of his evaluation. We have the profit part. We have the comps part of other practices around, and the third part was that capital expenditure. And it is interesting that he takes a rep from a dental company into the practice to see, like, hey, if we want to bring this practice back up to par, it's going to cost X amount of dollars, and he adds that back onto the price. It is a very interesting take. I do appreciate that he is trying to make it more sophisticated and give the buyer an idea what would be necessary to, bring that practice up to par. I
think it's a serious consideration too, because yes, there can be biases with equipment reps valuing their own equipment, right? But if a practice is dipping their own X-rays, no digital radiography anywhere. Yeah. And that's something that, you definitely, shouldn't run away from, but you should definitely have eyes wide open and kind of understand what that's going to be your first 6 to 12 months. And that means purchasing a lot of technology and equipment, which kind of comes into that purchase price.
Right. And that's going to be kind of catered to whatever you're expecting to be doing in that practice. I mean, some of that is assuming that, you have to upgrade certain things to be to a standard of care. But, other things like, replacing, this big CBCT that can take a lateral, ceph for ortho treatment. This is going to need to be replaced. But, maybe you're not really interested in doing that sort of treatment, or maybe there's like a diode laser that you don't even know anything about. And it doesn't mean something to you. So like, you're going to want to be informed about that yourself and know your own clinical skill set, because no one else is really going to be able to appraise that as well as you are. Yeah. And then I think another thing that came up to me, it was a poignant statement, and I'm probably not going to get it verbatim, but he said something along the lines of, EBITDA is a term created by tax attorneys and accountants to ensure job security, which I absolutely love, because I feel like we as dentists kind of do a lot of things to like get some jargon into our profession and like act like we're talking about something way more complex than we are. I love the word intaglio because it makes it sound like I speak like Italian or something. But it's beautiful, because if you ever want to like flex your business knowledge, just tell someone what EBITDA stands for.
But I don't know if people even know. I think they just throw it around. It's nice to throw it around.
It makes you seem very smart. But then, just it's more important to just understand like what it can actually represent. And I think it was nice that Matt said that, when he's talking about the business profit of a practice, it's the owner wearing two hats, right? In situations where you're in a solo practice, all that money's coming to you, and he doesn't necessarily have to talk in terms of EBITDA, because you're the one doing that work, and then you're making the business profit on top of that. Like it's not as important in that context, and so, but it is more important when you're talking about a group practice, right? Because you want to understand what the profitability as a business owner is, because you got other people using their hands and being salaried workers, so it becomes a more important topic over there. So I was really glad we touched on that, for sure. Yeah. Also,
And then kind of towards
he
the
did make
we had 3 ideas at the same time. Aaron, I had to make sure this was talked about. I really want to ask you if you could expound just a little bit on exactly what a harmonic mean was.
Tyler, I knew you were going to call me out on that. I just stood there and grimaced while that was going on,
seemed
just
like you
pretending like
knew.
I knew exactly what that meant. The worst part is I actually went to Wikipedia and read what that was, and I still didn't even understand it.
I thought we were getting into like music theory, and I was like, yeah, this is sophisticated.
Hey, this is the wrong podcast for that, I guess.
Yeah.
Part of practice evaluation, though. Yeah.
That is too funny.
But that was an absolute fantastic.
I think, wrapping up, I think 2 of the kind of big things to kind of look out for deal killers, right? One of them that he mentioned that I think kind of gets glossed over quite a bit, and people don't think about it enough at the right time, is real estate. That can kind of get it. That's again a whole nother can of worms that I think we're going to be having some future guests kind of doing a little bit more deep dive on what to look out for. When do we start this process of talking to the landlord? Does the owner own the building? Are you going to be buying the building and the real estate? So there's just a lot of considerations that need to be addressed before. And I think Matt mentioned kind of right as soon as the LOI is signed for the practice, that you need to start reaching out to the landlord. And his quote was that they're a third party that's very disinterested. And I think it's so true. So, and the other one was the asset allocation, the kind of the equipment versus the goodwill. And Aaron, can you kind of talk a little bit more about that, or Tyler, if you guys want to? What does that mean, and what does that mean for the buyer? What are the implications for buyer versus seller once they sell that practice?
Yeah, so one thing I think he said very eloquently, and again, I don't have it verbatim, but he said something along the lines of, the goodwill versus asset value thing are 2 diametrically opposed elements as far as like what buyers and sellers are going to be interested in, because they're going to get tax advantages in different situations. So a buyer wants to be buying more asset value. That's what they want, because as far as taxes are concerned, that's more things that they can depreciate the value on. That's a tax advantage for them. That helps their bottom line. Whereas for a seller, having more goodwill and correlated to that, less asset value means less things that they got to pay taxes on when they're selling the practice. At least that's as far as I understood it. And I think that was important to point out, because again, it's saying these are conflicting motivations, and this is a very important thing to have established early on, because it's the sort of thing that can absolutely disintegrate a deal, and it's a waste of time. It's an opportunity cost, and people get hurt in the process. So I'm very glad you brought that up, Clay.
On that point, real quick. So I remember him on a previous episode talking about that, and he said that that's a good place to let the seller have a win.
I remember.
If you feel like that you've been winning all the time, that's a good place to give something back to the seller, because you'll still be paying tax on it, yada yada, but it's all put over time, and so it's a great place to win some of that goodwill back for you as the practice closes. So I don't want you to get into it and be like, hey, this is where I want to win a battle. I think that's a great place to let that one go, let them win in that one, and then get some goodwill.
Right, because you want the practice. You want the practice.
It's coming out of that.
Yeah,
Let's get it done.
Yeah, you've gotten that far. It's like, we don't need to. This is not the hill that you want to die on.
Right. That's a good one. I was going to say something about breaking eggs, but I like that a lot better, Clay. That's
well, now I'm hungry, Tyler.
There you go.
Well, boys, I think that's a pretty darn good breakdown, and I think we ought to wrap it up. We got to be well over an hour now. So I just want to say I appreciate everyone that has hung around for the episode this long. We got through a whole lot of stuff, and I know there's going to be a lot of questions, and you guys are more than welcome to forward those to us via email at sbinterns@gmail.com. We'll go ahead and put that in the show notes. But again, thank you so much, and we'll see you next time.